Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. And many of you also know me as Mr. Valuation. This is another one of my ongoing Tuesday subscriber request series videos that I'm doing here. And the subject for this week's video is going to be on BDCs, or commonly known as business development companies that work under the sub-industry sector, asset managed custody and asset management firms. So it's a very interesting sector. A lot of investors are choosing to invest in it because they typically have very high yields ranging 7% or higher. But there's a lot of things I think a lot of investors don't totally understand BDCs well enough. Statistically, they often look very good, but there's a lot of things that you need to be concerned about. For one thing, the taxation of these things is something that a lot of people don't understand. BDCs aren't taxed at qualified dividend rates. In fact, I don't know that it's fair to call their distributions dividends. They're actually distributions. And they're not taxed at the corporate level. They're taxed at the individual's level. So there's a lot of things to consider. So, I'll be talking about that as I go through this video, but let's go ahead and start looking at some of the BDCs. And I'm going to try to give you some insights into how they work, what they look like, and hopefully increase your understanding and perspective of what a BDC is actually all about with a little more clarity than perhaps you've had in the past. So let's start by looking at BDCs here. And what I've done is I've put together a portfolio. I went out and I screened, and I came up with 42 BDCs. And, I've read numbers where there's 49. I think I've got most of them, if not all of them, for you here. But here's something I want you to first of all notice. One thing about these guys is they're typically leveraged. They borrow money. They invest in companies of $250 million market cap or lower. They're required to invest at least 70% of their investments in those kinds of businesses. They're very similar to a closed-end fund, and they're also very similar to a venture capital fund. The difference with a BDC is that they're available for the public to invest in, where most venture capital funds are limited to, accredited investors and high net worth investors. So, they are something that gives you the opportunity to invest in a lot of small companies. But the problem is their companies are not always, they're not well known. They're just starting out. There's credit risk. So you really have to evaluate these BDCs. And one of the best ways to do it is to look at credit ratings. Well, there are only 5 BDCs that have credit ratings, and they're all BBB minus. The rest of them you can see here have either no rating, or they just simply haven't ever applied for a rating, which, by the way, sometimes is what happens here. So there's 5 that are BBB rated or not. There are 3 that I'm going to showcase in this video that I think are interesting investments. There's also one that is considered very popular, and that's Prospect Capital, which I want to talk about. It is a BBB rated company, but what my job here is to give you a perspective. When you look at these companies statistically, they look okay. So let's start by looking at Prospect Capital Corporation to kind of illustrate what I mean. So first of all, I want you to note that the company has an earnings yield of 8.9%. Now that appears to be very, very attractive. The PE is 11.25, which is, considered very low. Using the Graham-Dodd formula, I'm drawing the valuation reference line here only as a PE of 9. So I want to make that clear. These are low valued investments in the first place. The normal PE is somewhere between we'll call it 8 and 9. The company currently yields 8.9%. So statistically, the thing looks good. It's BBB rated and only has 38% long-term debt to capital. But I want you to understand and see what's happening with some of these BDCs. Well, first of all, this company has been very, very tough to generate any growth over the last decade. And a lot of that can be attributed to the fact that the company has issued shares to the point of their share count's gone up almost tenfold just in the last decade. So they're constantly raising capital to raise more money to invest in more, private companies that they're funding and investing in. And then, of course, they're trying to generate money. But the reality of it is that look at the earnings per share. This is adjusted operating earnings. And I want you to notice that the adjusted operating earnings have actually been falling. Now, if I eliminate these first 3 years where we had good growth here, and I'll just try to shorten the cycle here, I want you to note that this company has actually shrunk earnings by 7.43% a year. Now, I don't have dividends plotted here with the white line. I have them plotted up here, but let me add dividends to this graph. And I want you to note that the dividend has also been shrinking over the years. back in, fiscal year 2010, and this company has a June fiscal year, they were paying $1.33. This year they're paying 72 cents. So you can see that dividend has fallen dramatically over the years. So have their earnings, and so has their price. So if I look at performance of this business development company starting, as of June 30th, 2009, we'll say just coming out of the Great Recession, I picked this time frame because this is also a time frame where the stock market itself did exceptionally well, as you'll see here in a second. So here you see the stock was trading at a price of $9.20, and it closed yesterday at $8. The dividend went from $1.33 to $1.21, $1.32 again, down to $1.77, and then 72 cents here more recently. So you can see there's been numerous times where the dividend has been cut, and cut rather dramatically. A $10,000 investment would have thrown off $13,000 in dividend income, or I'll say distributable income, we'll call it, compared to $4,518 of dividends from the S&P 500. But that $10,000 would only be worth $8,695 for a negative 1.2% annualized, decrease in value. And you add dividends and the what's left of the capital, you get 6.8% annualized rate of return versus 14.6 in the S&P. 10,000 in the S&P would have grown to 45,000 plus dividends, get you just under 50,000. That's almost a five-fold investment. This is without dividends being reinvested, okay? Notice the yield on cost has actually decreased for Prospect Capital Corporation. And again, a lot of this has to do with the way the companies are structured. Now, the way you're supposed to value, there are several ways that people like to value these business development companies. Net investment income, net asset value, which is also book value, and then dividends. Okay, so while we've got the graph here, let's look at the dividend yield. The best time to buy these things is when the dividend yields are high. And you can see back here in June of 2015, we had a 16.15% dividend yield. And so the company looked very attractive, but keep in mind they slashed their dividend. So, dividend yield doesn't work so well with a BDC like this one, whose, price has gone down, whose earnings have gone down every year. Let's go into fund graphs now, or financial underlying numbers, and let's look a little deeper under the hood of this business development company. All right, and what I want to first look at is I want to look at the company's share count. Now, I'm missing some data here for some reason, but the data I have is good. In June of 2020, they had 59 million shares. By June of 2010, they had 59 million shares. By June of 2020, they've raised that to 368 million shares. So you can see this company has been, very, very dilutive over the long run. That's one reason why they've had trouble, generating any money. Now, the other thing I want to look at here is let's go ahead and look at common equity or book value. I'm going to go ahead and take the shares outstanding off of the graph, and then let's look at market value, because I think this is very telling. This is a way that a lot of people like to value these investments. And what you see here is that this company is trading below its book value. The book value is about $1.9 billion. The company's trading at $3 billion. So it's trading below its book value. So that could be a tempting thing for a company, because they can go out, in other words, if they liquidated the company today, it's worth more than its actual book value or its net asset value, if you will. And that can be a dangerous factor when you're dealing with these BDCs. Okay, another thing I want to talk about when I'm talking about Prospect Capital specifically is I want you to look at their taxes. Okay, as I mentioned earlier, these are really interesting and kind of sophisticated from a tax point of view. First of all, non-qualified dividends are taxed at ordinary income. They don't pay any tax at the corporate level. That's passed right out to the shareholder, and it's reported on your tax return as ordinary income. And you also, have a place, you have to fill that in your 1099, but then they also have a portion of qualified dividends, okay? And you can see here that some of their dividends are qualified over the years. Some of their dividends are not qualified. The majority are not qualified. Now, you can also have capital gain dividends. The problem is this company hasn't had very much in the way of capital gain dividends, as you can see here. But the key is you got to be on top of these things with taxes. So that's something to consider when you're investing in these BDCs. I want to talk about another one. Another one similar, very popular BDC is Apollo Investment. I want you to see this same kind of pattern here. If I look at long-term performance, $10,000 has fallen all the way to $3,400. It's paid a lot of dividends, but you only end up with a 2.8% rate of return because, again, this company has had trouble keeping their earnings growing and their dividends growing for the similar reasons I mentioned with prospects. So let's move on now and let's look at 3 business development companies that I kind of like. So I've shown you what you want to watch out for, at least in my opinion, with business development companies. But let's go ahead and look at these 3, and let's start with 6th Street. This is one of my favorite business development companies that you can invest in today. It also has a triple B minus credit rating. The company is trading at a blended PE of 10, which is very attractive, has an earnings yield of 9.5 and a dividend yield of over 7%, and they occasionally pay special dividends. But what I want you to really see here is how consistent. Now, there's not a lot of growth here. Earnings growth has only been 2%. I want to make that clear. But their dividend has been pretty consistent, and they did pay a special dividend, $1 something expected for 2021. They already announced it. So, they do pay a special dividend occasionally, but if I look at their performance here, you can see that there's been very little dividend growth, but they've thrown off high yield. A $10,000 investment in 6th Street specialty lending would have, on March 31st, 2014, would have thrown off $6,379 in dividends versus $1,400 in the S&P. But once again, it did not outperform the S&P. It only turned 10,000 into 13,000, but this makes it more like a bond substitute that everybody's looking for, a high-yielding bond substitute. This company gave you back your money plus a little bit of profit, but they also paid you lavishly on dividends. So you end up with a double-digit 10% rate of return versus the total return of the S&P at 13% with a lot less dividend and more, potential capital appreciation. Okay, so 6th Street is a very interesting business development company that I think you can look at as well. And, the main thing here is you've got stability. It hasn't grown, it hasn't shrunk like we saw with some of the others. So the next one I want to look at then is Aries Capital. And this is another interesting one, very similar to one I just showed you in that we're not seeing a lot of growth here. It's, pretty flatline. Now the growth looks high here, but I want you to notice, again, I always try to make sure that you're understanding how to use the tool. I immediately see this surge of growth that happened here. So I'm going to shorten the time frame here. And what I discover is on a normal basis, this BDC has grown by about 2.29%, okay? My orange line here is a PE of 13 and the blue line is a PE of 10. That's about the multiple that this BDC consistently trades at. You need to be aware of that when you're making a decision. So technically, the blended PE is 11, the earnings yield is 8.35%, but it does pay a nice dividend of 8%. The dividend has been reasonably stable over the years, a couple of cuts here every now and then, but reasonably stable, and it's offering this nice yield. So when I look at performance, just like we did, a $10,000 investment in Aries Capital on December 30th of 2005 would have generated $14,396 in dividends versus $4,000 in the S&P over this same time frame. Your capital appreciation would have been $12,178. So again, it acted like a bond. It gave you back your capital and just a little tiny profit. So the total was about a 6.6% rate of return over this time frame versus 9% over this time frame in the S&P. But again, you got significantly more income. So if you're investing for income, these BDCs could be a good alternative bonds, except they're a great deal more risky than bonds. I want to make that clear. This one has proven itself to be a very, consistent performer over the long run here. So that's what this BDC looks like. Now, the last but not least that I'm going to show you here is Main Street Capital. I consider this maybe one of the more famous BDCs, but it's also my favorite because it's one of the few that grows. Okay, you can see its growth rates averaged about 8%. I'm going to shorten the time frame and get rid of an anomalous number there, about 5% growth. If you look at this company from the standpoint of performance, note that it was undervalued. Here I'm using a normal PE of 15 because this company does give me a little bit of growth. It has a little higher valuation. The normal PE is also 14.97. I know you can't really see it here, but you really have an orange and a blue line on this graph. Both of those lines just happen to be transposed here. So in this case, a $10,000 investment would have thrown off $24,000 in dividends. Note the growth of their yield on cost and note the growth of their dividend, very close to the growth of the company's earnings. $10,000 would have grown to $43,000. Slightly underperformed the S&P here, but only slightly. But add in the lavish income that this paid, and you beat the S&P handily, turning $10,000 into $67,952 versus $10,000 turning into $50,807 in the S&P. But this one had growth. Now, I consider it a little overvalued here, but this is one that I might want to look at if I could get it down here. I would like to be buying this BDC at around in the 30s, in the low 30s. So I would be waiting for this one to come back. A great time to have bought it would have been back here in March of 2020, as almost everything was on sale, good, the bad, and the ugly, by the way, obviously as a result of COVID. But you got to understand, it is a market of stocks, not a stock market. Not all BDCs are the same. They do have some tendencies, high yield. Because of the high valuation of Main Street Capital right now, we've only got a 5.8% current yield. Earnings yield's only 5%, and the PE is over 19. So it's more expensive, but perhaps for good reason than some of the others I showed you here. But the point is, understand the animal you're dealing with. BDCs have tax considerations. They can be very, very sensitive to interest rates because they use leverage. They should perform very well, as Main Street did when you have falling interest rates like we've had, for all the time that Main Street has operated here. In rising interest rates, BDCs could be very problematic, so that's something else. You also got to worry about default. They're loaning money to small corporations, startups, private investment firms or private companies that, may or may not have great credit worthiness. A lot of risk, a lot of challenges here. It's not just about the statistics, the high yield and so on. These are very different animals, and they do carry a lot more risk than your average company, in my opinion. And by the way, I've never really invested in them for that reason, but that doesn't mean you shouldn't. Anyway, this has been Chuck Carville saying, hope you enjoyed this look at business development companies. They're interesting animal, but I want you to try to recognize that you really need to know the nature of the beast that you're dealing with or investing in. If you like the video, give me a like, ring the bell, subscribe, give me a thumbs up, and all those nice things. I appreciate you all very much and look forward to talking to you again very soon. Thanks for watching.